What if I told you that you don't need thousands of dollars to start investing smartly? In fact, even $100 can be enough if you understand what you're actually buying. Now, here's the problem most investors are facing right now. Over the last 3 years, the stock market has been on a powerful run. After a sharp correction, markets bounced back hard in 2023. Momentum accelerated in 2024, and even though 2025 started off rough, the S&P 500 has already climbed strongly after recovering from early year turbulence. But there's a truth most people aren't talking about. A huge portion of this market growth has been driven by only a handful of mega-cap stocks. The headlines make it look like everything is expensive, especially the flashy high-growth names everyone talks about on social media. Meanwhile, quietly in the background, there are quality growth companies still trading at reasonable prices. Not cheap, not hyped, just overlooked. And that's exactly where smart investors focus. Today, we're breaking down 3 stocks priced under $100 per share that many investors may be ignoring, not because they're weak businesses, but because they don't dominate the headlines. Before we go any further, let's clear up a common misunderstanding. The price of a stock does not tell you whether it's expensive or cheap. What matters is what you're getting for that price. For example, Berkshire Hathaway's Class A shares cost hundreds of thousands of dollars per share, yet by valuation standards, they can be cheaper than companies trading at $200 a share. The real question is simple. How much business are you buying and what kind of cash does it generate? That's the lens we'll use throughout this analysis. We'll look at business fundamentals, cash flow strength, growth consistency, and most importantly, whether today's price makes sense. This breakdown was inspired by a popular financial article highlighting 3 no-brainer growth stocks under $100. While headlines like that are designed to grab attention, they often point us towards ideas worth investigating, as long as we apply discipline instead of hype. The 3 companies we'll analyze are Marvell Technology, a quieter player in AI and semiconductor space, DraftKings, a dominant name in online sports betting, and Uber, no longer just a ride-hailing app, but a demand aggregation platform. We're not here to blindly buy ideas, we're here to test them. So let's start with the first company, the one most people underestimate in the AI race, because what you're about to see might completely change how you think about cheap stocks under $100. Up next, a lesser-known AI company working with Microsoft and Amazon, and why its numbers look impressive but also raise serious questions. Don't miss this. Let's start with the first company on our list, Marvell Technology. At first glance, Marvell doesn't get the same hype as NVIDIA or AMD. It's rarely trending on social media. But behind the scenes, this company plays a critical role in the AI ecosystem. Marvell currently trades under $100 per share, with a market value of roughly $70+ billion. But remember, the share price doesn't matter. What matters is the entire business. When we look at Marvell's enterprise value, we see something encouraging. The company carries manageable debt, and more importantly, it generated over $1.5 billion in free cash flow last year. At that pace, Marvell could theoretically pay off its net debt in just a few years, a strong sign of financial stability. So what does Marvell actually do? In simple terms, Marvell designs custom AI accelerators and high-speed networking chips. These aren't consumer products, they're specialized components used by giants like Microsoft and Amazon to move massive amounts of data efficiently inside data centers. Management believes revenue could approach $10 billion within the next couple of years, driven by increased AI infrastructure demand.
The company has also expanded through targeted acquisitions, including firms focused on advanced optical technologies, a key area for next-generation AI systems. On paper, this sounds impressive, but smart investing isn't about excitement, it's about consistency. Here's where things get interesting. Marvell's long-term profit history is uneven. Over the past decade, profit margins have been low or inconsistent. In fact, the company only recently posted a very strong margin year, over 30%. That raises an important question. Is this the beginning of a new normal or just a temporary peak? While gross margins above 50% are excellent for a semiconductor company, investors must ask whether current profitability can be sustained once competition intensifies or AI demand cools. Revenue growth tells a mixed story as well. Growth has been solid over long periods, but it hasn't been explosive, and importantly, Marvell hasn't relied heavily on acquisitions to inflate results. That's a positive sign of organic business strength. Still, when we zoom out, we see a company with strong positioning in AI infrastructure, improving cash flow, but a history of inconsistent profitability. That combination demands caution. Marvell may very well be a long-term winner, only at the right price. And this is where many investors make mistakes. They fall in love with the story and forget to protect themselves from overpaying. So the big question becomes, does Marvell's current valuation actually reward investors for taking that risk? We'll answer that next by running the numbers and stress testing the assumptions. Coming up next, we put Marvell through a valuation stress test, and the results may surprise you more than the headlines ever could.
The second company on our list operates in a completely different world: online sports betting. DraftKings has become one of the most recognizable names in this space, and whether you personally use it or not, there's no denying its reach. The company has positioned itself as a category leader in a rapidly expanding digital entertainment market. DraftKings currently carries a market value of around $17–18 billion, and while profitability has been a concern in the past, something important has started to change. For the first time, the company is generating meaningful free cash flow. That matters more than headlines. Even though DraftKings has reported accounting losses over the years, its cash generation tells a more optimistic story. Last year alone, free cash flow moved solidly into positive territory, a critical milestone for any growth company. So what's driving this shift? Engagement continues to rise. Betting volumes around major sports leagues like the NFL and NBA remain strong, but the real engine behind improving margins is something many casual users overlook: parlay bets. Parlays are high-margin products for betting platforms. They're exciting, fast-paced, and statistically difficult to win, which makes them extremely profitable for the house. As these bets become more popular, DraftKings benefits from higher revenue per user without needing the same level of promotional spending. And that brings us to another key improvement. DraftKings is finally cutting back on aggressive marketing. In earlier years, the company spent heavily to acquire users, often at unsustainable costs. Now, as the market matures and brand recognition strengthens, DraftKings can reduce spending while still growing, a powerful lever for future profitability. However, this is not a risk-free story. DraftKings operates in a highly regulated environment. Laws vary by region, and changes in regulation can impact growth overnight. Competition is also intense, with rivals fighting for market share and new prediction-based platforms entering the scene. There's another concern investors often ignore: share dilution. Fast-growing companies frequently issue new shares to raise capital. When that happens, your ownership percentage shrinks, even if the business grows. This doesn't make DraftKings a bad company, but it does mean investors must demand a margin of safety. When analysts look ahead, expectations are aggressive. Many forecast earnings to scale rapidly over the next 5 years as revenue growth slows but profitability accelerates. If those assumptions hold, today's price could look reasonable. If they don't, optimism disappears quickly. That's why DraftKings isn't about hype, it's about execution. The company doesn't need explosive growth anymore. It needs discipline, efficiency, and consistency. And that makes DraftKings one of the most interesting and most debated stocks under $100 right now. Next up, a company that's no longer just an app, it's a verb, and its valuation might be far more surprising than you think. The final company on our list is one almost everyone has used, Uber. At this point, Uber isn't just a business name, it's a verb. When people need a ride, they don't say, call a taxi, they say, Uber it. That kind of brand dominance matters. Uber controls a massive share of the U.S. ride-hailing market, and user engagement continues to rise. Monthly active users are growing, trip volumes are climbing, and total bookings are expanding at double-digit rates. This is where Uber's real advantage begins to show: operating leverage. As more people use the platform, Uber doesn't need to double its costs to double its activity. Each additional ride, delivery, or order improves efficiency and pushes more revenue toward the bottom line. But here's what many investors still get wrong. Uber is no longer just a ride-hailing company. Today, it functions as a demand aggregation platform, connecting people to transportation, food delivery, logistics, and increasingly, next-generation mobility solutions. Behind the scenes, Uber is positioning itself for the future of transportation. It has formed strategic partnerships with companies working on autonomous driving technology, advanced mapping, and AI-powered routing systems. Uber doesn't need to build self-driving cars itself, it just needs to be the platform that connects them to users. That's a powerful position. Financially, the story has changed as well. Uber is now heavily focused on free cash flow, and recent years show meaningful improvement. While net income can fluctuate due to accounting adjustments, stock-based compensation, or one-time items, cash flow paints a clearer picture of operational strength. However, this isn't a perfect business. Uber has diluted shareholders over time, issuing additional shares to fund growth and compensation. That dilution reduces ownership percentage even as the company grows, something long-term investors must monitor carefully. Still, the market sees Uber differently today than it did just a few years ago. Analysts expect steady revenue growth combined with expanding margins, not explosive expansion, but sustainable profitability. That's often where the best long-term investments are made. So the real question isn't whether Uber will disappear. The question is whether today's price already assumes too much future success. And that's where disciplined valuation becomes essential. Uber may be a dominant platform with a long runway, but even great businesses can be poor investments if purchased at the wrong price. In the next part, we'll step back and connect all three companies together, and more importantly, talk about how smart investors avoid losing money even when they're wrong. Up next, how to think like a disciplined investor and why price matters more than hype, no matter how great the company looks.
Now that we've broken down all three companies, Marvell, DraftKings, and Uber, it's time to zoom out. Because the real lesson here isn't about picking the perfect stock, it's about avoiding the wrong decisions. Most investors don't lose money because they choose terrible companies. They lose money because they overpay, chase hype, or rely on hope instead of numbers. Every company we discussed today has strengths. Marvell plays a key role in AI infrastructure. DraftKings dominates a fast-growing digital betting market. Uber operates one of the most powerful consumer platforms in the world, but none of them are guaranteed winners at any price. This is where disciplined investing separates itself from speculation. A great business can still be a bad investment if you buy it without a margin of safety. Markets don't reward excitement, they reward patience and process. Instead of asking, how high can this stock go? Smart investors ask, what happens if I'm wrong? That single question changes everything. When you focus on valuation, cash flow, and realistic assumptions, fear starts to disappear. You stop reacting to headlines, you stop chasing trends, and most importantly, you stop panicking during market downturns. Hope is not a strategy. Hope doesn't protect your capital when markets fall. Hope doesn't help you sleep at night. Numbers do. That's why successful investors build repeatable systems. They rely on frameworks, not feelings. They know that avoiding big losses matters more than catching every big win. If you're just starting out, understand this. You don't need dozens of stocks. You don't need constant action. And you definitely don't need hype. You need clarity. Whether you decide to invest in any of these companies or not, the process matters more than the outcome of a single trade. And if you want to take this even further, if you want to learn how experienced investors generate income from stocks they already own, reduce risk, and stay consistent through all market cycles, then education is the real edge. Because markets will always change, but disciplined investors don't. They adapt, they analyze, and they survive long enough to win. And that's how real wealth is built. If you want to see how experienced investors generate monthly income from stocks without selling them, watch the next video on your screen. This is where strategy replaces stress.